Hello, and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Erik Clapsaddle, our Senior Fixed Income Portfolio Manager. This is the second of 3 videos as we discuss the investment outlook for 2026. And clearly, Erik, if we're talking about 2026 and you in the video, we got to be talking about the Federal Reserve. So can we start with kind of what's happened in the Federal Reserve the last month or two and what we see in 2026?
Absolutely. Well, the Federal Reserve has cut their target rate the past 2 meetings. So the latter meeting, they went from 4.5 to 4.25. The most recent, they went from 4.25 to 4. And now we're seeing about a 50% probability on December 10th that they'll likely cut again or not likely cut again. But whether or not they cut, we do think over the next few months, you're going to see an additional 0.25 percentage points of cuts. The quick backdrop is, outside of the past year, the Fed had been raising rates, and they did it close to the fastest pace on history, going from 0 to 5.5%. And they did that in the face of elevated inflation and a labor market that really had just become too tight, that they were trying to loosen up a little bit. Seems contrary to what the employer would want, but that's where we were at. You will see in this chart here that inflation has continued to be stubborn. It's been above the Fed's goal of 2% since March of 2021. It's projected in 2026 to remain above the Fed's 2% target, with estimates ranging from 2.5% to low 3%, largely driven by persistent wage pressure, a stable labor market, and to a lesser extent, tariffs. There is a growing chance that we could start to see we have seen some smaller signs of stress in the economy, specifically with lower income and middle income households. And if that takes place, we could see more cuts in 2026 than what we expect. But as of today, we're expecting the federal fund to have their target rate to low 3% by year end 2026.
So clearly the short end of the curve is headed down. Given that backdrop that you just shared with the Federal Reserve and a potential consumer slowing, what does that look like from a fixed income investor's return and what we might expect in 2026 and beyond?
So thinking fixed income big picture, we're actually feeling pretty confident about it going into 2026. 2 major components that will affect fixed income, though, are going to be inflation, whether it's rising, stable, or declining, and interest rate movements. We currently are fairly neutral in how we're weighted to maturities, meaning relative to our comparable benchmarks. But when it comes to inflation, you're going to see on this chart here that the real yield, which is the excess yield relative to inflation, has been attractive for a few years, has nicely remained well into positive territory, which is a great thing for savers, investors looking for less volatility in their portfolio. With our large exposure largely to the intermediate part of the yield curve and taxable bonds and similar municipal bonds, even though we carry a moderate leaning towards longer-term municipal bonds, the inflation outlook should help us carry yield at an elevated level going forward. Our primary allocation within fixed income is investment-grade credit, whether it be corporate or municipal bonds. And then outside of there, we start to allocate things like government mortgage-backed securities, taxable munis in a taxable account. And then we create a sort of satellite approach to that, adding things like high-yield bonds, preferred stocks, bank loans, and other asset classes that really diversify the portfolio and allow us to pick up additional yield overall. We believe, with all that being said, that it's going to create more of a better risk-adjusted return profile for the long term. And we think that should help us throughout 2026 as credit fundamentals likely remain sound.
So ultimately a pretty good year for fixed income investors under our current projections. Erik, last question for you is, manufacturing is obviously a big topic in the United States today. And in Michigan and Indiana, we have a disproportionate amount of people who work in the manufacturing sector. Why don't you talk about what's been going on recently and how that might play out in 2026?
Sure. So manufacturing has been a bit of a challenge for the past few years. That's coming off of a few great years. There's been a lot of change in technology. There's been a lot of labor challenges. And I would add to that just a general lack of demand the past 2 to 3 years. On this chart, the Institute for Supply Management points to the manufacturing sector contracting for 34 months out of the past 36. Anything below 50 means the overall manufacturing sector is in contraction territory. The large fiscal response to COVID in 2020 through 2022 pushed a lot of manufacturing well into growth territory for a few years, and now we are experiencing the continual pullback from it. The good news going forward is there is a large amount of automation, advanced technology now happening in the manufacturing sector. By multiple administrations through the years, we've seen a desire to onshore manufacturing back into the US, but we are still seeing some notable headwinds as I previously mentioned. Overall, though, the outlook for manufacturing in the States is fairly good once demand, of course, picks back up. One more thing to mention just out in this context to some extent would be skilled trade. Skilled trade has experienced a sort of renaissance over the past 1 to 2 years. And the reality is we think for decades to come, that's going to be the scenario. If you start thinking about things like HVAC technicians, plumbers, electricians, welders, they're in high demand to the tune of close to 1 million job openings or unfilled jobs that are out there, according to some data by Forbes. And with that, we will see, and we have seen some wage growth within that realm as well. The other positive within skilled trades is that there's a sort of lower barrier to entry. There's no time commitment to some extent as far as training goes. Of course, there is upfront, but then there's no financial expense like there is as of going to college. So again, thinking bigger into the future will also provide people with that more independence that the younger generation wants now, both financially and with time, and also allow them over time to start their own business.
It is interesting how the skilled labor market, which had been kind of pushed aside, is now having a bit of a renaissance, as you said. Erik, always appreciate your comments and the outlook for 2026. If you enjoyed today's video, I encourage you to share that with friends and family. If you do not currently subscribe to the Market Share, you can do so using the QR code at the end of the video or emailing us at wealthadvisory@firstsource.com. And as always, thank you for the opportunity to serve you and your family, and have a great holiday season.